Shareholders of Indigo have voted to accept an offer to take the retail chain private. This comes 27 years after the first Indigo opened and after some recent and public struggles. Jeannie Lee joins us with more. So Jeannie, walk us through what happened today.
Well, Andrew, the result was pretty much expected because a special committee of directors had recommended it, itself approving the deal and then turning it to the shareholders, who decided today to, as you say, turn the page. So here is what the deal comprises of. It's for $2.50 a share, or a total market value for Indigo of $69 million. And that's quite an improvement from where the market had valued Indigo just last September at $29 million, so more than double that value. The buyers are Trilogy Investments and Trilogy Retail, two holding companies, which already own 56% of Indigo, and the companies are controlled and owned by Gerald Schwartz, the private investment guru. And Schwartz is the husband of the founder and CEO of Indigo, Heather Reisman. And so together they own about 60% of Indigo anyway. The other 40% of shareholders had to look at this and say, you know what, we're getting more than what we were a little while ago. And this stock chart shows you exactly what has happened with Indigo shares. 5 years ago, they were trading at about $8 a piece, but then came the shock of the pandemic, which was followed by a recovery because of those lockdowns that kept people at home reading books and surrounding themselves with comforting things like candles and blankets and other things that Indigo also sells. But the bump did not last, and in the last year, book sales and the stock have languished, and almost sinking, in fact, to below the $1 level into penny stock status, which would have created a whole bunch of other issues. So the deal now closes in June, and Indigo becomes a privately owned company.
So, Jeannie, what does selling Indigo and turning it into a privately owned company accomplish?
Well, the customers of Indigo will not notice the changes right away unless, of course, one of the big advantages to becoming a private company is that you can make big, bold decisions without having to answer to shareholders. So this is what we should consider when we talk about companies going private. There would be more freedom to make decisions, especially big shakeups. A lot of people think that Indigo, those big stores at a time of massive rents, etc., maybe that's too much store for the fact that a lot of people are also shopping online. Now, there's also less distraction when you're at a privately owned company, when you're fighting already a lot of big factors like tough competition in the book business, and also very fickle customers whose tastes seem to change on a dime. And the fact is, retailing is hard, and Indigo has adapted over the years to many, many different changes, but you still do require a lot of nimbleness, maybe even more these days, when you react to the fast changes that are happening at the retail level. So you have that, and you also just have less scrutiny. For example, there was that period of time, a lot of stuff was happening at Indigo where the Heather Reisman stepped down as CEO, was replaced by somebody who lasted a year. Then she came back after retiring for just a month and started to run things again. So raising all kinds of questions which now don't have to be raised at all if you're a private company.
All right. Thanks, Jeannie.
You're welcome.